There are two things that I never do with my own money. If I ever found myself doing one of these things, I would immediately need to stop and evaluate the situation. Hi, my name's Randall. The featherless bird on my shoulder is Suki, and welcome back to 30 Day Investor. So recently I was asked by somebody, is there anything you do or don't do with your own money? And I thought that since the purpose of this channel is to document my exact trading strategy, that this would be a good thing to talk about. So here we are. Let's get into it. So when you're talking about things you don't do with your money, my number one is I don't listen to anybody about what I should buy and sell. That's not the CEO. That's not a pundit. That's not an analyst. That's not a friend or family member. And the reason is because they all have an agenda. Not all those agendas are bad, but they all have an agenda. And I want my investing strategy to be completely emotionless. So when you hear somebody talking about a stock, whether it be on TV or in a conversation or what have you, it's been my opinion that most of the things that are said are fluff of some type. So whether it's forward-looking fluff from a CEO or whether it's something a friend of yours read on the internet, the fact is that it's fluff. When I invest, I want to make sure that I'm looking at real world important factors, things like profitability, momentum, value, those types. Earnings is a great one, those types of things. I look at those. I don't worry about the emotional input. And the reason is because that gets really cloudy when the market does poorly. When the market does excellent, everybody's happy. But when the market does poorly and you don't have a system to rely on or to look back on, it becomes really difficult to stay in those trades that you're unsure of. Number two, I never hold through a bearish macro signal. Now, on my last video, I explained that over the years, I've developed a macro model that I rely on, but that wasn't always the case. When I first started investing, I basically used the 50-day, 200-day moving averages. And if the 50-day was above the 200, I was in the market. And if the 50-day was below the 200, I was out of the market. But one thing that has always remained the same is that if the macro model, whatever I'm using, says that I should be out of the market, I am out of the market. Now, over time, I've developed what I think is a pretty sophisticated, pretty reliable model that I use to make those determinations. And because of that, I rely on it exclusively. If it says I'm not supposed to be in the market, I am not in the market. If it says I am supposed to be in the market, I am in the market. And the reason is because if you think about it, the human brain is terrible at investing. We let emotion get in the way. Investing is the one place that people will buy high and sell low. Everywhere else, people are looking for discounts, they're looking for good deals, they're looking for bargains. Not in investing, we want to buy the thing at the highest price possible and hope that it goes higher. And quite frankly, hope is not an investing strategy. Now, on the flip side of this, the buy and hold community will tell you to hold the stock through the drawdown, and eventually it will come back. And that is absolutely true in most cases. However, sometimes that can take years or even decades. If you look back to the Great Depression, the stock market took like 30 years to recover. 30 years. I don't want to wait 30 years to get my money back. I'd much rather be in a position where I either sit those time periods out or I'm invested in something that does well in those time periods. I don't want to be guessing. And this is doubly true when you think about if you lose 50% on an investment, you have to make 100% up just to get back to zero. Just to get back to zero, you have to make 100% of that money back. So because of that, I do my best to not be in those types of markets. Now that we've talked through two of the things I never do, which is listen to somebody else and hold during a bad macro environment, let's talk about some things that I do with my money. So number one, I use an algorithmic quantitative process for investing. And that goes back to what I just said. Human brains are terrible at investing. They want to buy high and sell low. And that's not something I want to do. So I take emotion out of it and I allow the numbers or the math to work for me. This allows me to buy a set of stocks that I feel good about, not because of some hunch or thing that I think is going to happen, but because the math lines up. And if the trade goes wrong, I can look back on the math and go, this was still a good trade. And if the trade goes right, it validates my mathematical position, and that allows me to move forward toward the next trade that may or may not go wrong. Now, the second thing that I do with my money is to invest in a stock portfolio that I really only touch once per month. And the reason for that is because if you're looking at your stock portfolio on a weekly or daily basis, the fact is that you're going to be nervous when it goes down and it could lead to overtrading, potentially getting out of investments that you should be in. And if you're only looking at it once a year, then it can lead to stagnation, where basically you're holding investments that haven't been good in quite some time, but because you only look at it once a year, you don't really realize that. As I've indicated in past videos, I have about 25 years of experience, and over that time frame, what I've figured out is 30 days works best for me. So longer, and I feel like it can lead to stagnation, while shorter, and I feel like it may not give the trade enough time to develop. So I came up with 30 days. The other great thing about 30 days is, from a practical standpoint, it allows me to invest without having to monitor. So in other words, I look at it, I invest, I run my macro model on a regular basis, but from a stock standpoint, unless I'm exiting the market in between, I'm really only touching those positions once every 30 days. And that process that occurs once every 30 days really only takes me about 20 minutes to do. And the third thing that I always do with my money is focus on concentrated five stock portfolios. Now, I know that this isn't necessarily popular. The financial industry focuses or pushes strong diversification. And the fact is that strong diversification is just fine. The problem is that you're almost guaranteed to mathematically never beat the market. That's not what I'm interested in. I want to put myself in a position where, yes, I may be taking more risk, but I'm also mathematically in a much better position to beat the market if my trades do well. Now, don't get me wrong, not everybody holds this position. One of the strong proponents of this, at least historically, one of the strong proponents of this has been Warren Buffett. Now, recently, he's actually moved to a you should invest in an index fund mentality. But if you look back at some of his earlier work, he talks about the fact that it's much better to invest in a small group of stocks that you believe in as opposed to investing across the board in a large number of stocks. And while I don't necessarily agree with everything involved in Warren Buffett's investing philosophy, I definitely agree with that. When I developed my quantitative investment process, I wanted a process that required the stocks to ruthlessly compete for position. So I wanted to look at very specific factors that created a list of stocks that was very, very controlled and very, very specific. And that's what I've done. Like I said, that doesn't necessarily mean I always win, but it means that I can always look back and go, this is where I wanted to be. The math says this is where I should be. I kind of think of it like this: diversification dilutes returns, whereas concentration, especially systematic concentration, has the potential to significantly drive higher than expected returns and put me in a position where I am making the kind of money that I want to make on my investments. So that's it. That's really the framework. And it really comes down to exactly what we've talked about before, or exactly what I've talked about before, which is five stock concentrated portfolios managed once a month without emotion. Now, if you found this interesting, or like I've indicated before, if you just want to see me crash and burn, do me a favor, like this video, subscribe to the channel. Also, make sure you turn on the notifications because I do put out the videos of my actual trades and what I'm actually investing in. It may be something you're interested in knowing. Most importantly of all, just remember, when I'm investing, it's no emotion, just execution.